Hello, everybody, and welcome to the show today. So today we're diving into my favorite topic, money. We're actually going to be talking a lot about wealth. We're going to talk about a lot of strategies. We're going to talk about a lot of things that you need to know to actually listen to what your money is telling you. So there's so many cool tips that we're going to dive into. And with us today to talk about these is R.C. Peck. Now, CFP sits at the intersection of money and human behavior. And for over 20 years, he's helped people hear what their money is trying to tell them. He struggles with dyslexia, watching his parents' life savings get embezzled, and his background in neuro-linguistic programming taught him to question the obvious. He now uses his ability to see what others can't see, which brings clarity and insight to a world that's often described as confusing and overwhelming. His message is clear. Listen to your money. It's trying to tell you how to get the life that you want. So to learn more about that, here's RC. RC, thanks for joining us today.
Hey, man. Good to be here.
I'm excited you could be here. I mean, this is an interesting theme. I've never heard it mentioned this way before. So I guess let's start there with the obvious in the beginning. What are you talking about? When you say listen to what your money's trying to say you, what are you kind of referencing there?
So, I mean, for a second, let us just set aside all of these ideas, how money is this or money is that, or like, you know, we kind of learned that money isn't everything, and I'm not presupposing it is, but what if money had a voice? And what if its voice was actually trying to tell you what to do with your money? But because we get so hit with news and noise and confusion and overwhelm, we literally don't know, like, our money's in the corner of the room saying, don't do that again with it. Like, don't triple down again on Bitcoin in December of 2017. No. Get away from the stove. No, and I believe it's not just a metaphor, but I believe if you know how to listen to your money, right, it would actually say things to you like, yeah, Bitcoin in December 2017, probably not. And this is not a hit piece on Bitcoin. So the reason people have not thought about it is because, you know, I believe we've been taught that we're the center of our money. We are asked to talk about our risk tolerance. Like, we're put in the middle of our money. And we've seen every stock market crash through the lens of our eyes. So it makes sense that we think we should be in the middle of it. But I think that's a mistake.
That's interesting. So give me some examples here. I mean, what are some ways, what are some things that you see that money is trying to tell us that we ignore? And second question, I guess, is then how do we start hearing it?
Yeah. The simplest things are the hardest to hear. So I mean, we could do 3 hours on that, on that idea right there. But for example, I believe that most people who buy pick of the month newsletters, or who may even have, say, a big box advisor, I believe most of them have probably come across an article in some form or another that says to beat the S&P 500 index is exceptionally hard over any 5 or 7 year rolling period. Like 97% of people cannot do it over any 5 or 7 year rolling period. Okay. Now add to that, if you add in the dividends from the S&P 500 over that, because if you look at all the research that talks about how it's difficult to beat, and by the way, I'm not an indexer or a buy and forget. So if anyone already said I'm out of here, just hold on. But if you think about all those articles are written about just the index and they don't include the dividends. And then if you do, then you're like, wow, it's almost not impossible, but it's almost impossible if you're not listening to your money. Like, why not start with the index, reinvest dividends, and already get to the front of the line? So I think that money kind of tells us the place to start, like with health. Do you even eat well? Well, no, but I work out. Well, you know what? Working out doesn't matter if you're not going to put clean energy in your body. And you probably know that, right? Because most people start working out with their body first, and then they start to go, wait a second, I'm not fueling my body right. So it's the same kind of thing. Like, if you start listening to your body, which means you actually have to start working out. If you start doing what's best for your money, not for yourself, then your money starts going, look, start with the index, reinvest dividends. Let's get there. And then let's talk about how to avoid those 50% falls. So it's kind of listening to the obvious.
Makes a lot of sense. Why do you think that a lot of people then don't hear what their money's telling them?
The first thing we're taught, like take 1,000 people, they read a book or they go in to see an advisor. One of the first things, and it's they don't even see it, because whether they go to this branded person or that branded, like everyone, when you walk in, they talk to you about yourself. Well, Ty, what do you want? Like, what's your risk tolerance? Hey, Ty, what year were you born? Because the stock market cares the year you were born. So we want to put that center. And so since me questions get asked almost immediately at every type of advisor-like or money-like conversation, we don't even know to question it, right? But the thing is, the stock market, it does not care when you were born or how you answered those 20 questions about your self-described risk tolerance. So we're not even taught, we're taught to be like, well, it's our money. And I was born in 1962 and 1982 and 1952. So immediately we put ourselves at the center of it. So I think the idea of even putting our money or the stock market at the center of investing, it's not even, it's hard to even think what is never different.
Sure. What do you do if we use Bitcoin as an example? Let's say it's whispering to you, hey, don't do this, don't do this. Well, it's easy in hindsight, right? But how do you really pick up on those signals? I mean, how do you really start paying attention to what your money's telling you so you're not the center of it, and start paying attention to that message to take action? So using the Bitcoin as an example, how does that work? I mean, what signs? Because I can tell you in business, for example, what I've learned is that the biggest disasters happen or the biggest disasters lead to the biggest moves forward, right? But then I've come to realize that there were plenty of signs that disaster was going to happen, that if I just recognized those signs, I could have avoided the disaster and still got the result of making changes for the positive. So yep. I guess that's kind of what I'm asking about the money side of things, is that I think the theme here is that the money's trying to tell you lessons that you're ignoring. So how do you pay attention to that? How do you start to pay attention to the lessons that are being learned? How does that work? Like in that Bitcoin example, for example.
Okay. About 55% of our brain is designed to see patterns with our eyes. I mean, our eyes are feeling, but our brain was designed to see patterns, specifically patterns in the tall weeds that could kill us, right? And so over the last 100,000 million years, the brains that got to today, your parents, they designed a brain to see visual patterns. Okay, now step into the world of investing, and we read books. Okay, books have letters and words and sentences and paragraphs and pages and chapters. Okay, our brain wasn't inherently designed to decipher those codes. And if you put these 4 codes together, it makes this code, and 8 of those codes makes this sentence. And so what our brain has had to do is it's had to take non-visual information. We can talk about what visual information, but it's had to take non-visual information, and it's had to make up pictures of it. So let's say someone that you trust and like, and let's just say they're good looking and they went to Harvard and their spouse is better looking than your spouse and their car was made in Germany, and they say to you, Ty, you've got to get out. You've got to get into Bitcoin. It's the future. It's going to replace gold. And by the way, this person is a very good writer. All right. So you read that story, your brain reads that story, and it's loading up images, gustatory feelings, sounds, but it's all happening below the surface, right? You're loading up like, God, this is, you know what? I've worked really hard, and maybe this is it, because it's loading up this experience, but it's almost unconscious. I mean, you can feel a little bit of it, right? But what's happening is the brain literally is putting up these images of like, this is how it's supposed to be, right? But what if someone showed you an image instead of a story, okay, or words, letters, sentences, it showed you an actual price chart of Bitcoin, okay? And so let's say, you see this picture, all right? And literally the picture is going straight up like that, okay? Like not this sustainableness. And let's just say you took we'll make a presupposition, but let's just say something going straight up like this can't go over, right? So it either can go straight up forever, or at some point it's gonna, just the physics of life is gonna have to have it come down, because we know as humans, when we see something unsteady, we know instinctively, like, I don't know, $22,000 and the price by itself doesn't matter, but your brain sees and goes, that it's not going to bend over, and I know things don't, go to the heavens. So God, I'm starting to feel anxious about it. That actually doesn't look stable. Like, and let's say you took a 5-minute course on what stable looks like. Let's say stable's, that's stable. And so by replacing words, letters, sentences, paragraphs, news stories with an image, that in a sense is like, your money's like, oh, you might love Bitcoin, but that doesn't look like a good future right there, at least not right now.
Makes sense. What do you do then? I mean, because what we're trying to ultimately do here is be predictive, right? So, and I get that, what you've got to recognize these signs that your body is telling you, right? Because it makes sense. 76,000 generations of hunter-gatherer. Our minds are designed to help us avoid like stuff that's going to get us eaten and killed, right? I mean, that's ultimately what it comes down to. So it's naturally built in with all these indicators that, like you said, we oftentimes ignore, that are trying to tell us something. So how do you do this? How do you predict an investment outcome? Because naturally, logic will tell us what goes up must come down, right? I mean, there's a lot of things like that, physics and basics that we understand, but how do you use that investing? I mean, how do you go about using this to predict the income or the outcome of a potential investment?
You take a big step back. How's that for a big answer? There are only 4 places on this planet our wealth can be stored, right? So I don't know what age I got my first dollar for my birthday, but as soon as I made my first dollar or was given my first dollar, I was an investor, because currency is a part of fixed income, right? So when I had that $1 bill in 1975, I was an investor, and I had all of my money in fixed income, specifically currency. So the first thing people, again, it's like, it's so obvious once you hear it, but there's only 4 places on the planet for your wealth to be stored, right? You can put it in equities, and let's just set aside private companies for a minute, because I know it's really companies, but let's talk about the public ones, and let's just say equities. So you have equities, you have fixed income, you have commodities, and you have real estate. There are some fringe things like rare wine and rare cars. You could either call them commodities or real estate, but you have these 4 asset classes, and that's it. And that's where your units of wealth are stored. Okay. So then I'd want to know the next question, what historically has the best general growth of all 4 of those assets? And it's hands down stocks. It's hands down equities. It's not a free ride. Every so often they get cut in half. By the way, most of the assets get cut in half too. But because stocks are, more people have them and they can see the price change every moment, it loads up the wrong parts of our brain. So the first thing one of the first things I say to people is, you're already an investor. I'm going to wait until I get some more money to invest. Or yeah, I've been investing for 20 years. No, you've been investing since you've been 6. And so just the reframe, like, no, you actually started as an investor. And by the way, investing has nothing to do with how you earn money, right? There are countless courses and training to learn how to make more money. And a lot of them are good. What happens is when people make the money, they then confuse making it with keeping it. And it's like going from professional baseball to figure skating. They take the rules and the characteristics of the wrong sport and they bring them into ice skating. They go, God, it's really dangerous over here. I'm getting beat up. So I think really the first thing is to take a huge step back and go, you're already an investor. In some ways, you are almost born an investor by default. And you only have 4 assets. Find the one that has historically, Newton's, one of his first laws is something in motion stays in motion until something of equal and opposite force pushes back against it. And stocks have been the thing that have been doing best the longest. So again, what we talked about at the beginning, like just start with what's the simple thing but hard to see.
What kind of assumptions do you think people make in this process that leads them to make bad investments?
It's all going to come crashing down tomorrow. Everything's but the rug's going to get pulled out again in the middle of the night. I'm going to wake up and it's all going to be gone. Right. So someone will then reference like 1987, when the market fell 22.6% in one day. And so they have this experience, this one-off experience. And because the brain's designed to survive life, it goes, look, just in case that lion is at that one spot, which it's never been before or since, but we can't guess if it's gonna, because there's no half dead. And so we assume these one-off things are gonna take us out. And so because people have not been taught to think visually, or to listen to what their money is trying to tell them, they assume that something's gonna jump out of the closet at every moment. And so they create this system to protect them, but it's not actually protecting their money, which gets back to you got to take yourself out of the center. And I can use those words and we go, okay, take your money out of this, or take yourself out of the center. But hearing the words and understanding how to do it are different. So knowing that our brain is designed more to earn money, because earning's like killing the buffalo or the bison or the wildebeest. It's designed to kill, because that's kind of like what earning is. But our brain's not designed to, kind of staying with the same metaphor, grow the mammoth. It's just designed to go kill some more. And this whole idea of investing, which by the way is a very, very, very new idea to the human brain. The limbic system, the amygdala, it doesn't quite understand it from a survival standpoint.
You think U.S. stock markets, non-U.S. stock markets? I mean, what do you advise there? Do you think it's a good idea for people to invest here in the U.S. or even look at like investing outside of the U.S. as well?
I think it's good if you can be Spock, who was half Earthling. People forget he was half Earthling, but to not care. To care about yourself, to care about your spouse, to care about your family, to care about your cause. But if you didn't care where your money was, and I don't mean like I can't do tobacco companies. I mean like if you didn't care whether your money was in an international fund or in a US domestic fund, all you cared about was being the one that has the stability, right? So there's two ways to measure stability. It's in an absolute uptrend. So it's kind of going up and to the right, and you can visually see that. And the other thing is have it be in a relative uptrend, right? So meaning if you price it in a different currency, it's still trending up and to the right. So like I've had my clients avoid international for 10 years, zero. And we've touched into it, but I believe one shouldn't care whether it's all international or all domestic. What they should care about is where the stability is.
So when we talk about this investing and kind of getting away from the words and starting to put things into pictures and images, something that our brain obviously recognizes better, how do you go about doing that to kind of find leaks or holes in your existing investment strategy?
If I introduce the idea of a picture to someone, first of all, it's, so I'm 48. I started this deep dive when I was in my mid-20s, and I lived outside of Manhattan, and I had some friends who worked in the trade towers, and I went to a lot of the big box advisors. And I can tell you just the idea of looking at a price chart was laughable. Now, most of them were men. They were wearing $1,000 suits. They were older than me. They all came from top 10 universities. And just the idea of this naive 25-year-old being like, well, can we just look at a price chart? And they're like, oh, son, you have so much to learn. So just the idea, even before I get to your question, just the idea of looking, I mean, if you think about it, what do you own? Do you own Walmart, the company, or do you own Walmart, the stock? And my answer is you own the stock. You own that black squiggly line, right? Walmart getting caught for bribing people in Mexico. This happened years ago. The stock went up. So if someone can stand back and look at 3 years of a price line, right? Not 3 days, not 3 hours, not 3 minutes, because our brain's designed to want to go 3 minutes or 3 hours or 3 days. And then people go, yeah, looking at price charts don't work. It's like, yeah, your perspective is off. But if you can step back and look at a 3-year price chart or a 4-year price chart and go, okay, that's going up and to the right. Now, I don't know much about XYZ, but I got to believe if that black line keeps going up and to the right, whatever they're doing at that company, that 400 to 500 million people that invest in developed markets around the world, collectively, they're like, they've got something figured out over there. I don't like the person who runs it. I don't like this. Okay, but that's your opinion about something else. If you're asking where's the stability, right? And so if you can step back and look at, say, a 3 or 4 year price chart in the right way, your brain goes, oh, that's looking up and to the right. Obviously, our brains will go, but it's going to fall. But that's a million-year-old brain protecting itself. And so we got to go back to Newton, whether it's his first, second, or third law of motion, something in motion stays in motion until an equal and opposite force. And that's the thing. So if you have this company that is hitting on all cylinders, something really, really, really big needs to hit it in equal and opposite force to stop that. And that's why you have companies like Dwight and Church that can go in this beautiful, almost 45-degree angle up and to the right for years and decades.
What do you do? I mean, how do you kind of what questions do you ask yourself before you invest to really get the right idea, paint the right pictures to be able to know you're making the right decision? Is it that you're looking at that 3 years, or what kind of things could you do and questions you should be asking before you even think about investing to make sure that you do feel good about it, that your money is talking to you saying it's a good thing?
Yep. Okay. Let's say you're looking at, just throw a stock out to me. Just give me a stock.
I don't know. You said Walmart. I like that one.
Okay, so let's take Walmart. Let's say you think Walmart's amazing. Just as a company, you love it. Okay. Well, here's a couple of my rules. You are not allowed to buy Walmart at all unless it's outperforming the S&P 500 with dividends reinvested, right? So you have USA Inc. It's $26 trillion in size. It's been around 243 years. It's survived internal wars, external wars, murders, turmoil, and it's still around and it's still going up and to the right. So if Walmart cannot be outperforming the S&P 500 with dividends reinvested, you have zero business being in that, because Walmart, I don't know what it is actually, but it's a $150 billion market cap. And if this little teeny tiny entity that hasn't been around 243 years can't even outperform this $26 trillion company, why invite that price volatility into your life? I don't like why questions. So I don't like, what would that person be doing to invite that type of price? I'm just going to use the word violence, potential price violentness. And the answer would be, it could only be to bring in a lot of excitement. I don't want my clients to be excited about their investing in this same frame. The other thing is, if Walmart's part of the staples sector, if Walmart's not outperforming the staples sector, discretionary staples, you have zero business being in Walmart, right? So people, I don't think they're not given a frame of relativeness, right? And we're taught to think in words and hear how well Walmart's doing and how it's this and how it's that. And it's like, okay, wow, I love the Sam Walton story. I actually do love the Sam Walton story. But it's turning our brain off. And I want to turn our visual brain on and go, great. Hey, you like Walmart? Good. Is it beating the S&P 500 with dividends reinvested? And is it beating consumer staples? No. Sorry. Yeah, but I really want to. Go buy a share. And I will, with my heart open, I will be direct with my my clients and my training clients, people are like, so you're saying you want to bet on a company that you know is losing right now, but it's going to turn around. Okay, so you want to go north out of town. You see the bus heading south out of town. You believe the bus south out of town is going to turn around and head north out of town. How about you just wait until it gets back to town and heads north out of town? I don't want to miss out. Miss out on what? The space between heading south, turning around, and going back to town. Oh, you do. You do want to miss out on that. And see, that's where the training comes in. That's where that's what humans want. We want that first 10%, right? And that's what actually hurts people.
I see. What other things do you think should be taken into consideration when somebody's just developing an initial plan for investment?
Well, again, get yourself out of the center of your investing. It's your money. You worked hard for your money, but you have no business being at the middle of it. No business. So move yourself to the side and then say, look, get that these 4 asset classes don't care about you, don't care when you were born, don't care how you answer those questions, but learn how to look at the 4 of them, right? And just know, like, hey, if stock, like, think of it as like 4 runners. If there's 4 runners going on the track, a 400-meter track, and there's literally only 4 runners, which runner's in front? Okay, well, if it's a stock runner in front, then we pretty much know we have economic stability going on in that country or the world. But if stock runner is like doubled over, like heaving in the back, I don't care if you're 26 and you're aggressive and you can handle it, you do not want to be in stock. And by the way, the stock runner doesn't go from lead to throwing up off the track in a night. That happens over many, many, many months and quarters. People have just never been taught how to actually notice that. So obviously I'm using a metaphor, but you can actually watch these 4 runners. And then this turns you on to thinking visually. And so then if you do hear something that scares you, right? So fill in the blank person who's got his PhD from, Yale goes, have you seen the GDP numbers? Have you seen what the price to earnings ratio is? The last time it was this bad was 29, 2000, and 2007. What does your body do? I'm going to die. Okay, because we heard words, we loaded up images, and we got the heck scared out of us. And so now we're going to start taking action when there's nothing in the bushes, right? So I don't mean to give too many pronged answer to this question, but get to a picture. Get to a picture, right? The economy is shrinking. Okay, well, let's look at not a picture of the economy. Let's just go look at the stock market. And it probably knows about it already because there is not a higher floor on a building than the one that the stock market has. So it sees the clouds and the storm coming way before we do.
Well, how do you know if you've messed up already? How do you know if you've made a bad investment? And then, like, what do you do to turn it around? Because, like, if you're on the bus going south, you don't want to get out when you finally get as south as you're going to go before you turn around and go north, right? So, like, how do you know you've made a bad investment, and what do you do to turn it around?
It's a great question, because let me just change it. I'm going to answer your question, but let's say you're in a marriage for 3 years and you're fully in, like, legal documents signed, right? You're like, I made a mistake. It's really hard to get out of that marriage. You have to sometimes involve lawyers and legal documents and always judges. So getting out of something like that is pretty difficult. Okay. People think that's the same thing with their ticker symbol, right? So they assume they got married to GE, and there was a ceremony, a marriage ceremony between them and GE, and there's hopes and dreams wrapped up in that. Now, I'm not diminishing people at any sense, but what happens is people wrap up their hopes and dreams into the symbol and not the strategy, right? So one of the first things I want people to really get, like, your future stability has nothing to do with GE or Walmart or the S&P 500. Those are just vehicles. The real thing that's going to get you the stability is the strategy. So if someone did buy, let's say they bought GE and they followed the rules. GE is outperforming its sector and it's outperforming the actual index. and you buy an individual stock. So one of the first things I teach my clients to say is, when will I lose? When will I lose? Not if, but one of the first questions is, so when am I going to lose? And I have them say the dollar amount. So let's say you had $1 million and you put 50,000 into GE, 5%. And I told them that you're never, ever allowed to lose more than 25% of your initial position. So that's 12,500. So I'll actually have them say out loud to their spouse or to me. So I say, I'm going to buy GE and I'm going to go lose $12,500. Like, I'm going to lose it. It's going to go away. It's going to be taken from me. Okay, and do you still want to buy GE? Yep, it's passed all the rules. I've done everything the right way because I followed the steps. And RC, I'm going to go lose 12.5. We'll say it out loud, $12,500. That's what I'm going to go lose. So if the person can't even say that, or if they start defending themselves, if they start saying, no, I'm not going to lose. No, this is it. Like, you already know they're going to lose a lot more. So I want their brain to hear the words and to say the dollar amount, not I'm going to lose 2%, or hey, you know what? I'm going to set a stop loss. Brain doesn't really know what a stop loss is. It knows what $12,500 is, especially if you make $12,500 a month or $12,500 a quarter. You're like, oh, you're going to lose a quarter of your year's income. Yeah, I am. Right. So those words they start saying, those are literally loading up a different experience in the person's body. And people learn how to use different words. Words create your world. Literally, their brain gets rewired in how they think about money. And they go, yeah, I'm going to lose 12.5. Right. So they're prepared for it. They're prepared for the right hook. And then when it doesn't happen, it eventually will happen, even if it's 6 years later.
RC, this has been really enlightening. What do you think I haven't asked that I should have for all those people that are investing and doing it wrong, or maybe looking into getting into investing and starting and wanting to do it right from the beginning?
They're going to hit a lot of resistance. But the thing I can say most is that if you can't see what it looks like, you're already in trouble. Right? And if it can't even outperform the sector it's part of, you already lost. And if it can't beat the S&P 500 with dividends reinvested, by the way, which almost no one measures against, you already lost. It's simple to say, but it's about getting to a picture fast, an actual picture, a conscious picture.
Well, where can everybody go to learn more about your strategies? I think you teach traders as well. So where can everybody go to get more info?
Yeah, whether you're a trader or investor, whether you love it or you have to do it, there's only one place, and it's fearlesswealth.com. It's my website. It's been my website for 2 decades. And the next step is super easy. You just go visit fearlesswealth.com and you can get to my Kool-Aid stand.
RC, thanks for coming to join us today.
All right. Thanks so much.
So look, everybody, if you're looking for some really interesting tips and tactics on investing and being able how to really listen to what your money is telling you and get a good visual picture of what you need to be looking at, instead of letting your mind become confused with all these words and other things, make sure you go to fearlesswealth.com. Okay, RC has a ton of great information that will help you make smart investment decisions and stop making bad investment decisions, or not even start making bad investment decisions. And it's all at fearlesswealth.com. So make sure you visit fearlesswealth.com for some tips and tactics and a strategy and development of a strategy so you can invest the right way to let your money talk to you, hear what it's saying, and make smart investments. So make sure you visit fearlesswealth.com. Thanks everybody for tuning in. Have a great day.